So Jefferies reported a significant drop in the average age of buyout funds sold in the secondary market, with 39% of LP deals involving funds of 2019 or later vintages. Then that's the first half of this year. And those funds are trading generally at smaller discounts than earlier vintages, which you would expect. Does this align with what you've been seeing? And given that funds with vintage years of 2019 or later are making investments during a time of record valuations, why do you think investors are willing to accept a reduced discount to acquire them?
There's a lot to unpack there in terms of the duration of what is being sold versus kind of the ongoing opportunity set. I think when you think about the duration, one of the comments I made earlier is private companies staying private for longer. And so there's going to be a natural trend that you see of some of these fund vintages when normally it might take 4 to 6 years to invest in a company, get your value creation that you need, find the right opportunity to sell at a hopefully increase in multiple to generate your 2x or 2.5, 3x if you're investing on the growth side. It's just going to take longer now to get to that exit case. So it's not surprising that what we're seeing is, secondaries market started with a little bit of a tail end cleanup kind of mindset, but today people are actually selling recent vintages or 2, 3, 4, 5 year vintages as part of their generating of the distribution and liquidity. So that's kind of point number one. And two is you're starting to see cycles. I have a feeling that in some of these 2019 to 2022 vintage funds, they may start to look like the 2005 to 2008 vintage funds in the sense that it just took longer. The market is still quite competitive, even though, when you think about the lack of fundraising and smaller fund sizes, deal environment is still very competitive to find the best companies. So it's taking longer to deploy the capital. And then IRR just kind of sneaks up on you before you realize. And when it does, it's very, very hard to course correct at that moment in time. So my expectation is that there will be some funds in that 2019 to 2020 vintage where, in 5 more years, some of them may not be at their carry or may not hit carry. This is probably more prevalent in buyout because on the growth side, I think some funds actually don't even have a carry hurdle. But on the buyout space, I do think you're going to see a little bit of that cycle repeating of some of that kind of, crisis fund. And then on the last point, I think we think on the secondary side, you can buy high quality companies wherever it sits. So there might be a really good company that's been sitting in a fund, a GP's fund for many, many years, but then there's something that's happening in the ecosystem or in its industry that's causing an inflection point. And if that is the right way to invest by buying in it through a secondary, that's the way we're gonna, buy into it. If the best way to invest into a really good company is when it just got invested and there's some LPs that are looking to their unfunded commitment is too high and they want to sell some recent vintages, we'll buy it that way too. So I think when we think about our investment philosophy and our investment strategy, it's just we're pretty flexible in terms of how we get access to these companies, whether growth, buyout, venture, credit, whatever the kind of company, and we're just kind of very flexible how we get through it, either on the secondaries market or on the kind of direct side.
All right, so Lee, will you close us out? Because we have 1 minute.
Sure. So, from a secondary standpoint, we also cover the marketplace of GP-leds and LP stake transactions. We are predominantly focused on the GP-led segment of the marketplace, probably 90% of what we do. It's really a function of our overall focus on seed early stage venture on the venture side and smaller funds on the buyout side, where our ability to really leverage that relationship and source GP-led transactions. Because we know these companies in the portfolios, we're able to watch them grow within the funds. And then obviously there's usually a good reason why the sponsor wants to hold that for a continuing period of time, but nonetheless their clients, their LPs are looking for liquidity to some degree. And so we're very happy to step into that marketplace, buy that one asset that we've been tracking for several years and be able to hold it for another 3, 4, 5 years if that's the opportunity set in front of us. And so for the last 10 years, we've done about 100 GP-led transactions, and we've proven to ourselves that that's been the most compelling risk reward for us in the secondary marketplace. And it's a growing part of the marketplace. It's There's obviously debate is if it's going to eclipse the LP stake marketplace. We don't really care. We know that our platform's growing, we have these relationships, and that's our opportunity set to really capitalize on secondaries.